want to ask you, I mean, the data has gone from the horrific when you look at claims to the mildly encouraging, at least month on month from some of the numbers we're getting out today. We know what what equity investors are clearly banking on, sort of collides with what the minutes told us out of the Fed yesterday. What are you seeing in this reopening that seems sustainable?
Well, first of all, it's a good thing I'm not an investment strategist or a money manager, because I would have gone bankrupt a long time ago. I'm very puzzled by the equity market valuations. I mean, we all know the S&P 500 only off 8% year to date. I think there are three possible explanations for this. One is that investors are looking ahead to a very strong 2021, and perhaps for a vaccine sooner rather than later that can be produced in big volume. I find that dubious, because if you look at the mainstream economic forecasts like CBO over the past 48 hours, which was released over the past 48 hours, CBO is forecasting a very weak 2021, and that growth at the end of 21 would be only 1.6%, that it would take 3 years to recover the lost output as a result of this economic contraction, and that earnings, S&P 500 earnings, would not return to 2019 levels in 2021. So that you look at that, you say to yourself, if investors are looking for a strong 2021, where is that going to come from? Second possible explanation, of course, is just the sheer amount of monetary expansion. Between the Fed and the ECB, their balance sheets are approaching a $10 trillion expansion. M2 is growing 15%, when 2% is considered normal. This is a version of the Stan Druckenmiller argument the other day, when he referred to the market as being the most overvalued he'd seen since 1999. But it's also a version of what happened in 2008 and 2009, when the Fed actually targeted equity values in order to improve consumer net worth, household net worth, and promote consumer spending. So that's a possible explanation. And the third is the obvious, which is that market's overvalued and will correct. I'm not smart enough to know which it is, but I have to say the argument that the market is ahead of itself seems a logical one to me, including that our investor surveys show a lot of bearishness. And of course, a lot of money is coming out of equities right now.
Yeah. So it sounds like you think there will be a reckoning once the second order effects become more evident, right? Once household balance sheets begin to crack because of the scarring of unemployment and the like?
Well, there are two, Carl, cliffs, so to speak, which are straight ahead here. One is the expiration of the payroll protection program loans, which is June 30. And the other is the expiration of the extra premium in unemployment insurance, and that expires in July. And so you ask yourself, will the recovery have proceeded to a level where the economy can take those expirations in stride? Or alternatively, will those two programs be extended? I don't think the recovery will have proceeded to the point where it'll just absorb those easily. And if they're not extended, and it's hard to tell now, I must say I think that's a real problem. But there are some strange things occurring that you hardly ever see in the real economy. One of them is that incomes are actually up because of unemployment insurance making up for all lost earnings among those who are qualified for it. And that's a very big number. We saw continuing claims this morning, I think, at 24 million. And the other is that household net worth is actually up because consumers can't spend because of the lockdown. That's the opposite of what we saw in 2008, 2009. Now, that may not continue, but it's odd to see that. And that's a cross current versus these cliffs, these expiring cliffs.
Roger, just want to, it's Sarah, throw another headwind at you.
Hey, Sarah.
Because you've sort of guided us all along on China and U.S. versus China. The president really taking it up a notch, some scathing tweets where he accused China of a massive disinformation campaign. on the coronavirus. I mean, to me, that was as close to pointing the blame at President Xi Jinping as he's come, something he has not done. So where does this go? And what sort of economic headwind does it represent?
I think this is going south, meaning that the U.S.-China relationship, which already has deteriorated a lot, is going to deteriorate further, at least for the next 5.5 months before Election Day, because the president needs some enemies. If you look at the latest polls, he's not doing very well. And China is enemy number 2 behind Vice President Biden. So he's going to get, I think, increasingly hard on China. And if you look at those Commerce Department rulings of the past 3 weeks, and you look at some of the interesting announcements, for example, from Intel and TSMC, you see that there's a rethinking of national security going on in terms of what we need for domestic production. I happen to think it's a bipartisan issue. I think Democrats generally agree. And I think the so-called Cold War in technology and otherwise between the U.S. and China is deepening. And that's, to some extent, unfortunate, but that's the way it's going.